My name's Dipesh Patel, editor at Trade Finance Global. This week, we've been at BAF's Global Payments Conference. The payments landscape is changing at great pace. Driven by a total shift in consumer and corporate behavior, financial institutions, banks, and technology providers are facing the need to adapt and adapt fast. Today, straight from the Global Payments Conference, I'm joined by Ken Wong, who's joining us from Toronto. Ken is Director of Global Banking at TD Securities, and today we're talking about cross-border payments and digital payments. Ken, welcome to Trade Finance Talks TV.
Hi, thank you for having me.
So, quick introduction and elevator pitch in no more than 30 seconds. Who are you? Where are you from? And what do you do?
Sure. Obviously, I'm Ken Wong. I'm from Toronto Dominion Bank, so known as TD Bank. I'm based in Toronto and part of the GTB product team. I specifically look after product strategy and innovation for the Global Transaction Bank. What that really means is I look at what's happening in the future and look for ways to enhance my clients' proposition for them.
Thanks, Ken. So, what are the biggest themes in payments right now? Is the huge uptake of cross border e commerce changing consumer and business behavior?
What I think is the what has not changed, but the how is and has changed. Let me explain that a little bit further. From a what perspective, for years now, digitization and choice has been the main themes from a payments perspective, regardless of whether it's cross-border or domestic. What has happened with COVID-19 is we've had to accelerate that digitization and choice so that consumers could reach businesses and businesses could reach consumers to actually get the commerce flow going. But what I think is there's a limit to innovation right now because of how antiquated our present payment systems are. So the how is what is limiting us, and that's where the big themes are coming in right now. If you look at the traditional ACHs and RTGS, I feel that they are not built or fit for future innovation. Even with the real-time rails coming in, they operate more or less the same way as RTGS and ACHs, except that they are 24/7, 365, which is much better, but they still operate on basically the same general principles as an ACH or RTGS. To really leapfrog in innovation and in the payment space is, I think we need to change our mindset and therefore change the operating models of how money moves. I think there's a great potential for CBDCs or central bank digital currencies, which really will change the way that money is moved. And therefore more innovation can be thought of utilizing a CBDC. And then the question about, I guess, both consumer and business behavior. I don't think anything has really changed in the sense that the wants of a consumer or business have always been the same. It's the ability that is changing. So from a one perspective, every consumer wants to be able to buy from anyone in the world at a good price. And every business wants to reach everyone in the world to sell to anyone in the world. So that has not changed. What has made it difficult, I guess, until recently is the technology hasn't been there to allow that. So the ability was not there for the connection between the businesses and the consumers on a global basis, and payments on a global basis was difficult. So with the advent of the internet and the creation of marketplaces and storefronts, literally a consumer could reach any merchant around the world. So that's step one into, I won't say changing behavior, but getting to the wants. The payment part is the part that I guess is a little bit more difficult. But with credit cards and debit cards coming on, the exchange of money has flowed much, much easier. However, not everyone has a credit card, not everyone has a debit card. So it comes back to the theme of choice again, is we need to find more ways that people can transact, move money between one another so that I can have greater ubiquitous reach, and therefore the marketplace would be bigger and I can actually buy anything from anyone then.
Thanks, Ken. So it's all about the how is rather than the what. Let's talk about real-time payments. And obviously, as you mentioned, payment processing is moving towards 7 by 24, 365. How does the bank need to adopt?
Okay. From a real-time payments perspective, I see that there are 5 things that a bank has to look at. All right. One is client access. So how's a client going to actually access the faster payment system so they can actually either pull money or push money to someone else? The other thing is the availability of the ledger systems within the bank itself. Third is the payment engine itself, right? Is it running 24/7? Fourth, liquidity availability. You need money in the system, or the banks need money in the system before you can actually move client money. And the fifth is operational availability, because it's going to be 24/7 by 365. So let's tackle the easy ones first. I think from a client access, payment engine availability, and operational availability, those are the easy parts. Why? If you look at all banks today or marketplaces, they already run 24/7, 365. So it's just a matter of putting another interface, a UI into it, so to allow clients to make a faster payment itself. The second part is the payments engine. I don't think any bank who's putting up a faster payment system is going to use any of the legacy systems. So since they're buying new, they could do anything they like, right? Any vendor, run it any way they like. So it will be 365, 7 by 24, 365 available. Last but not least is operational availability. It's a new business scheme, and therefore you need operations to actually support it. And depending on the bank strategy, most banks already have a 7 by 24, 365 call center at least. So we always have people running it. So for these 3 factors, it's all about investment, resources, and operational overhead. I think those are easier from a physical perspective. Whether you get the money is another thing. Can't say anything to that. From a ledger perspective, that's trickier. There are, I guess, from a legacy perspective, our ledger systems don't run 24/7. And I don't think any bank is going to replace the ledger systems just for real-time rails. So what do they need to do? Do they need to enhance it some way? Again, replacement is a bit difficult. Or there are other ways of looking at it. So if you look at the precedence of an ATM network, ATM networks already run 24/7 by 365, right? So why can't a bank utilize that methodology of what we call, I guess, a mirror ledger for the downtime and run it off that? But then it comes to what risks the banks are willing to take, or what restrictions the banks are willing to put on the client to use something like a real-time rail. So from an ATM perspective, we know, okay, for each card, for each debit or cash withdrawal, I limit them to say $1,000. I know that my loss potentially is $1,000. But then if you look at real-time rails, some real-time rails have got no limits. Look at Australia, right? So is the bank going just in its off hours say it's actually no limits and take the risk, or inconvenience the client during those hours to say ledgers are down and therefore I limit you to say $5,000 worth of transactions? So that is something a bank has to, I guess, decide for themselves. Change the systems, enhance the systems, or take some risk or put some limitations on the client. Liquidity, I think, is actually the hardest one to resolve, right? Because number one, you need liquidity in the system. And every single, I guess, faster payment systems, the settlement processes are different. Some are net settled, some are like a real RTGS PVP. But what makes things a little bit more difficult too is the funding and defunding of the liquidity within the RTRs. Most of that, we use the RTGSs to fund in and out. RTGSs are not running 24/7. So during the day when the RTGS is open, okay, I can monitor if I'm running low on liquidity, I can pump more in, I can do whatever. what happens during the off hours, what happens during the weekends. So the liquidity managers, the cash managers have to really monitor what the flows are within the system and say, okay, it's going to be a 3-day long weekend. People are traveling. I need to pump so much liquidity in the system and just let it sit there. And hopefully I don't run out. But then I think that the cash manager just can't say, okay, I've dumped the liquidity there. I can go away for the weekend. They still have to monitor it just in case they run low. But the question then is, what happens if we actually run low liquidity for one bank? We need more mechanisms within the RTR, because I cannot actually move money in because the RTGSs are closed. Do we have a scheme of interbank lending at that point in time? So I can borrow from another bank within the system so that my transactions can still go on, which means I still need someone to monitor it 24/7 by 365 and have a contact with other banks within the systems to say, I'm low in liquidity, who's willing to lend to me and at what price? And then move it within the RTR to the correct spot.
Thanks, Ken. So I guess the liquidity issue and it seems like a much greater issue there. But I guess on the operational side of things, is there a space for fintechs here to help the banks, I guess, achieve some of those processes, or is there an element of competition there?
I think that's a bit of a misnomer to a certain extent, where everyone always says fintech are in competition with us. I think in some cases, yes, but most cases, fintech always rely on a bank. Again, depending on what type of fintech we're talking about. If it's a payments fintech, then they still rely on banks because they have to get into the payment systems. But then what we're talking about, I guess from a real-time, real perspective, it's operational running of the actual payment system. So I believe that, there will always be some smaller bank out there who do not want to build up the entire infrastructure just to run that. Especially if you look in the US, there are a lot of smaller banks there that they can't afford to build up a complete infrastructure and operational shop. What do? They outsource to I guess process managers, people like First Data, right? Where they can actually run the technology, or they rent the technology from them and they outsource the processing of them so they can get in play too. So I think from a connectivity, or rather from a business perspective, the banks will run it themselves. From an operational perspective, why not outsource it if you have to? I don't think it should make any difference.
Thanks very much, Ken. So now moving from payments into currencies, and more specifically central bank digital currencies, which you've been talking about at the BAF Global Payments Industry Conference. What is a CBDC and why has there been so much interest lately?
Sure. I guess from a CBDC perspective, there are two types that everyone talks about: a wholesale CBDC and a retail CBDC. From a wholesale perspective, if you look at the money in a central bank today, it is already digital, right? So the question always is, from a wholesale perspective, especially in a domestic setting, do we really need one? All right, so that question mark is still out there. I guess the attention has been garnered a lot more is in the retail CBDC side, right? And I guess what's the difference between a retail CBDC and what we do today? I guess the primary difference between a CBDC and how we move money and what we consider value today is a CBDC is on central bank liability, whereas the money in our account, the money we move through our credit cards, through the payment systems itself, is actually commercial bank liability, right? Not central bank. So why is there so much interest? You have to look at the different demographics of different countries to say, do I actually need a CBDC or not? So one of the things, one of the areas that people talk about CBDC is actually financial inclusion, right? I have an unbanked population. The question then is, why is that population unbanked? Is it because there are physically no banks there? Is it because the population don't trust the banks, but trust the governments? And therefore, if I had a CBDC, then financial inclusion could be resolved because it's actually issued by the central bank and you're not taking a commercial bank risk, right? Another area where I think CBDC could be very interesting is the concept of storage of value. So again, in countries where people don't, I would say, trust the government, and therefore, the currency is something that people actually don't want. So if you look at some countries, people buy US dollars and hide it under their beds because US dollar is stable, right? So could CBDCs be that because it is actually, backed by a central bank? I don't need something physical that, you've heard horror stories where, oh, house burns down, guy loses a few $100,000 because he's put it on his mattress. So this might be a safe way to store value. And for, I guess, in developed countries, why do people buy T-bills, right? It's because it is central bank guaranteed again. CBDCs could be a form of a replacement of a T-bill, as an example.
Absolutely, and I think you've really got to look at where the demand is and what the key problem is. So both from a retail and a wholesale perspective, can CBDC drive innovation in money markets?
When you talk about money markets, I guess you're talking about the debt market and that kind of thing. That is an interesting question because it also depends on how CBDCs are actually implemented, right? So in the session yesterday, with some central banks, they said their vision of a CBDC is that it will never pay interest. So other than doing swaps from a currency valuation perspective, why would anyone hold a CBDC from an investment perspective if it doesn't pay any interest? So it all depends on how the CBDC is actually implemented, what are the features of it, how can I move it around, who can I move it to? Then we could actually make an assessment of whether we can innovate in the money market for it, I think.
Thank you. So what's in stock for 2021 when it comes to the future of CBDCs, in your opinion?
In 2020 for CBDCs, I think it is still, we are still in the learning phase. Yes, there are countries like China, like Thailand, they've actually implemented CBDCs, call it on an experimental basis, right? But if you look at all the other countries around the world, whether it's US, Canada, the UK, everyone is still studying it to say, is there a use case for it? And I think there is the potential for CBDCs, like I talked about the innovation plateau. A CBDC could help us bridge the innovation plateau. But what that would mean is I feel that is the central banks have to get together and design a CBDC that's fully interoperable. Then we can actually make much better innovations of, from a payments perspective, from a collections perspective, from an investment perspective even. But until that happens, I think we won't really see too many CBDCs going to full distribution, not in 2021 at least.
Thank you, Ken. I guess optimistic, but also cautious there. I think that piece on driving collaboration and interoperability is incredibly important when you're considering CBDCs. Ken, I'm afraid that's all we have time for, but thank you very much for joining me on Trade Finance Talks TV. It's been a pleasure, and we look forward to the rest of the BAFT Global Payments Conference. Thanks.
Thank you for having me.